Oil prices continue to slip this week, down about 3% as fears over tensions in the Middle East perhaps starting to ease, coming off of 4 days of losses when it comes to WTI. Joining us now to discuss what's going on with that bifurcation there is Bob Iaccino. He's Path Trading Partners co-founder and chief market strategist. Bob, thanks so much for being here. Explain this to me, right? Because we went into the week thinking that the geopolitical tensions that we've seen starting to bubble over, that was bullish. That was supposed to be bullish for oil, and now we're seeing 4 days of losses.
Well, it was short term, right? I mean, when you're looking at geopolitical tensions, you're looking at the ultimate thing being the supply disruption, and that didn't happen. When you had these sort of massive attack from Iran into Israel that didn't turn out to be massive at the landing point, that kind of tempered the view that Israel was going to reciprocate, or I should say respond, in a way that would disrupt the supply. Iran is not a small producer. Despite the sanctions, oil is fungible. Oil goes one place, and then that place doesn't want the demand from another place. So you're talking about a country that produces between 2.8 million barrels and 3.1 per day, and that's not small. So when you consider that that could have been disrupted, the early move that we saw, the early trade from the speculators looking at that being a driver of crude oil was a big deal. Didn't materialize, still could. But when you're talking about the supply and demand dynamics that are going on longer term, this may turn out to be a pretty good buying opportunity. Technically, if you get below 79.50 in WTI, the June WTI futures, for example, and that sustains, then you worry about lower price levels. But outside of that, this is likely a buying opportunity because bigger picture, demand is likely to exceed supply in the medium term.
But when you talk about that move higher that we could see, how are you talking triple digit oil? What's going to bring that conversation, $100 a barrel? What would bring that conversation, the extremely bullish view that we had seen, back into play?
Well, Shani, you're talking about geopolitics to get to $100 a barrel. That's what gets these surprise shocks and sustainable shocks, depending on the assessed damage. If there were to be a geopolitical, I keep calling it geopolitical, we're obviously talking about a military strike that disrupts supply, then that would get us somewhere near that $100 and possibly exceeding it, depending on what that disruption would be. So it could be dominoes, right? It could be an attack that disrupts supply and then a closing of the Strait of Hormuz, because you saw during the pandemic and the supply disruptions with the supply chain that we had as a sort of a general economic factor, how to hurt the West. And Iran knows that. If they wanted to hurt the West, that's the way they would do it, is they would continue to disrupt supply even after a strike. So that's what would take us there. I'm talking about just a general supply and demand imbalance that's developing. We're about to go into the strongest seasonal tailwind for crude oil that we're going to get. We get sort of a flat level in the end of April, and then it starts to spike in May through, say, late July, early August. That's a seasonal tailwind. We're going to have U.S. production tail off, and then higher interest rates slows the transition away from fossil fuels. So that's another demand spur. Fossil fuel projects need, or I should say but really need lower interest rates. So if rates are going to be higher for longer, or if the 10-year and further out is going to continue to rise, as some people having it moving up to 5%, that's going to disrupt supply slowly.
And I realize when you're talking about some of these inflationary dynamics, it does make me think about the big November event that we have coming up with the presidential election and the degree to which the Biden administration is going to allow for oil prices to rise significantly heading into that date. To what extent should oil investors be thinking about strategic petroleum reserves and the impact that could have on the price of oil?
Well, there's only so much that can do. After the first tranche of SPR releases that we got last year, the Department of Energy said it only affected gas prices by about 17%. I'm sorry, 17 cents, which is very different from 17%. That's from the Department of Energy. And these are temporary supply distributions that have to go to refineries that may be overloaded in the first place. So it isn't necessarily going to translate to the pump in any sustained way. Also, we're very depleted in the SPR. So try and think about combining a massive supply shock through geopolitical events, possibly a closing of the straits, which Iran can do, likely won't, but it's possible, and a widely depleted SPR that got refilled by about 20, 25%, don't quote me on that percentage, But the power of the SPR is greatly diminished at this point.
Bob, before we let you go, we want to quickly talk about the price of gold because that's obviously been something that's on our radar. We're right near those record highs. We had Citi on earlier this week talking about the fact that we could actually see 3,000 an ounce. What do you think is likely at this point? And how much higher do you see the price of gold headed?
Well, I'm tired of Citi following me because about a year and a half ago, I said 2,800 by the end of 2024. Somebody should call them and tell them at least give me credit. I think 3,000 is a stretch, but I do think gold continues higher from here because from my perspective, there's three outcomes. You're only looking at rates from here staying at this level by the Fed or lowering them, right? Lowering them pushes gold higher. Keeping them here, if we continue to get currency debasement, which is different than inflation, pushes gold higher. There is no talk of a Fed rate hike, which is the thing that would push gold lower. And then the secondary factor is gold is an asset. And if we get renewed inflation, which I'm a believer that we're going to get, gold is an asset. Asset prices participate in inflation. Your home does, your land does, stocks do, and gold does. So there's not a lot of scenarios, at least as we speak right now, the three of us, that pushes gold that much lower.
All right, Bob Iaccino, always great to talk to you. Thanks so much for hopping on with us this morning. Path Trading Partners co-founder and chief market strategist. Thanks.